Singapore's central bank says that monetary policy remains unchanged as there's sufficient room for the Singapore dollar to ease. This comes as economic conditions weaken because of the coronavirus outbreak affecting countries like China and Singapore. An economist says that Singapore's growth outlook may even slow further if the situation persists. Tan Se-hui with this report.
Travel restrictions are in place to stem the flow of visitors with recent travel history to mainland China. That's why some analysts expect inbound tourism to Singapore to fall significantly. That's because Chinese tourists make up about 20% of total arrivals. Without tourism spending, it could have a negative impact on the economy. Despite the weaker economic outlook, the Monetary Authority of Singapore says it will not change its monetary policy. In October last year, MAS reduced slightly the rate of appreciation of its policy band. It guides the Sing dollar against a basket of foreign currencies of its trading partners.
The effective exchange rate itself, it basically means that it just moved from near the higher end of the band down perhaps to the lower end of the band, and we'll essentially say we don't have to do anything because there is what the policy band is designed for, to allow for such near-term uncertainty either on the upside or on the downside.
For now, it seems that the status quo remains, and Mr. Song says that the average consumer wouldn't be impacted. That's because key partner currencies are also weakening alongside the Singapore dollar. But he says that things may change if there is a greater period of uncertainty. Such uncertainties include more job losses and even a disruption in supply chains. If these issues persist in Singapore and elsewhere, experts believe it may prompt the central bank to act.
If the virus outbreak were to worsen, in that not just the hospitality, transportation sector being affected, but across all segments of services, then that's the kind of period where the MA say, okay, growth outlook has changed, inflation outlook has changed, policy outlook must also be appropriately adjusted as well.
MAS is monitoring economic developments closely, and its next policy review is scheduled in April.